More than 95% of all LTC is sold to people over age 50, but we're seeing more of this coverage marketed and sold to younger insurance buyers. Part of the reason for this is purchasing contracts younger is cheaper, and they are more easily qualified for the policy. But because of the older demographic, deceptive and unethical sales practices were used more, and many clients were conned into buying replacement policies to earn new business commissions. This also had the result of placing insured in constant states of confusion. But legislators began creating laws intended to shield LTC purchasers from these misleading sales practices. In 1991, the U.S. Department of Health and Human Services published a report on how states were regulating LTC and how it affected consumers. Then in 2009, the NAIC published its first LTC Model Act. It spelled out protections for insured, laid out model coverages, and helped states begin creating laws and rules for LTC. LTC contracts require buyer's guides and outlines of coverage to be delivered to an applicant at specific times during the sales transaction. It's important to remember that seniors are granted more legal protections than younger health insurance policyholders. For example, LTC policies may not have elimination periods longer than 180 days, whereas a standard disability income policy could have a significantly longer waiting period. Benefits periods cannot be less than 2 years in LTC. This is because statistics have shown that the average stay in a nursing home is about 2 years. Laws are in place to protect LTC insured against unintentional lapse by giving the policyholder the option of adding a secondary addressee to receive premium notices. And if the policy does lapse due to non-payment of premium, there are non-forfeiture provisions in place to ensure the policyholder does not lose all of the contract's benefits. Long-term care partnerships in Florida were also detailed. These contracts can be a great benefit to LTC purchasers by protecting the insured's assets in the event Medicaid LTC is needed in the future. We also discussed various required inflation protections that must be built into LTC policies. Inflation protection is a critical part of making sure the available benefit keeps pace with the cost of LTC facilities and lower-level benefits. The next section of the lesson brings you back to group insurance and explores the realm of small employers and group insurance. Small groups of 50 or fewer insured make up the majority of group contracts. But insurers have been historically hesitant to take on small groups due to the lack of risk spreading that exists in large groups. Because of this, states created laws that require insurers to take on smaller groups, and Florida has its mandates that you'll learn. Florida's Employee Health Care Access Act was created with the purpose of expanding the availability of health insurance coverage to smaller employers, regardless of their claims experience or their employees' health status. Prior to this legislation, these issues could easily allow an insurer to decline a policy to a small group. The laws also protect small group insureds against arbitrary cancellations and non-renewals, undeserved rate increases, and their ability to include open and special enrollment periods. Marketing and advertising will be reviewed, and you'll see that many of the requirements are similar to those you've seen in this lesson for other products. We'll take a look at the Florida Healthy Kids Corporation. This was created through legislation after it was determined that access to healthcare services could improve children's health and reduce the incidence and costs of childhood illnesses and disabilities. We'll finish the section by discussing the requirements related to HIV infection and its related conditions. Group policies, including small employers, must cover HIV like any other medical condition and cannot use the disease to cancel or non-renew a policy in Florida.